system narrations that are there. Use of what we call the system existing notes. You can also talk about reading system and manual where they exist. Reading, what we call the system, and what we call the manual where they exist, where we say they exist. So you read what we call the system and what we call the manual, especially where they exist. Reading the systems and manual, especially where they exist. So, but again, as an auditor, you can observe what we call observation of what we call procedures. We say observation of what we call of procedures. So we understand that through this, you may be able to understand what we call the client system. Together, team. You will be able to understand the client system. Give me a yes if you're together. So then we proceed to the second procedures. We call it recording the system. We call it recording the system. So when it comes to recording the system, you basically understood, you have an understanding. Recording the system, you basically give information on what you basically understand about the system. So we say auditors recording. This is auditor recording. What we call understanding of what we call of the client system. So based on how you comprehended the system, you put it down on paper together. That is what we call recording of the system. So techniques when it comes to recording, we can have here techniques. We can have the techniques. So through this, we can basically have what's called the techniques. So how can you basically record a client system? What are some of the techniques that you can basically use? So one of the techniques, we call it narrative notes. Respond to the yes together. One of the techniques, we call it narrative notes. You know it together. Narrative notes. So when it comes to narrative notes, these are short notes describing accounting and ICS. Short notes. We call it describing what we call the accounting, and what you have the ICS, describing what we call the accounting and the ICS. These are short notes that describe the accounting and ICS, while at the same time, making comments, what we call comments, and what we call criticism. At the same time, making what we call the comments and what we call criticism. So these short notes on describing what we call the ICS and the accounting system, but at the same time, you make comments and what we call criticism. Then we can also have descriptive, we call it questionnaires, the descriptive questionnaires. So on the descriptive questionnaires, we're basically saying these are questions asked by auditor to be answered by a client. Questions we say asked by the auditor, and you say to be answered by the client, So when you talk about descriptive, questions asked by the auditor to be answered by the client. But when you look at descriptive, they require short answers. Brief to describe, control. Short answers involve short short to what we call brief answers. Answers to do what? To describe. We call it to describe what we call the control. To describe what we call the control. Short answers basically to describe what we basically call control processes. Short answers basically to describe what we call control processes. You know, short answers, but the essence of them is basically to describe what we call control processes. Then you proceed to what's called a flowchart. Flowchart. We proceed to what's basically called a flowchart. A flowchart. So look at him. So whenever we talk about what we call a flowchart, we're basically saying that a flowchart is diagrammatical representation of companies' procedures showing accounting functions and documents. So we call it diagrammatic. Flowchart is diagrammatic. We call it representation of what we call of the company. Representation of what we call the companies, procedures. Representations of the company's procedures, showing flow of accounting function, showing what we call flow of what we call accounting functions, and what we call documents. Showing what we call the flow of accounting functions, but at the same time documents. So when you talk about a flowchart, if you look at a flowchart, it is grammatical. You will draw it. It shows what we call a company's procedures, showing what we call the flow of accounting function, but at the same time, how documents basically move in the system. Respond with a yes. Respond with a yes. So I want to go deeper into the importance of a flowchart. Importance of what we call flowchart. Importance of what we call of a flowchart. What are the importance of a flowchart? When you talk about a flowchart, what are the importance? You don't need so many stories. Simplifies what we call recording of ICA. Simplifies. One of it, simplify. We call it recording of what we call of the ICS. It does simplify what's called the recording of the ICS. It simplifies what's called the recording of the ICS. They say it involves what we call little expenditure. We say it involves what we call little expenditure. It involves what we call little expenditure. It does involve what we call little expenditure. 1 minute, little expenditure. So when it comes to flowchart, it does involve what's called a little expenditure. It does not involve much. Let's see, little expenditure. It does involve what's called little expenditure. We can also talk about what's called it's consistent. It is consistent. We say it is consistent. It is definitely, when we look at a flowchart, we say it's consistent. System that is standard. System that we say that is what we call standard. It is a consistent system that we say is basically standard. Then we can talk about it, say, auditor will get the whole picture. Auditor, we say gets what's called the whole picture. Auditor gets what's called the whole picture. The auditor will get the whole picture of company's operation, of what's called the company's operation. So if you check the flowchart, you'll definitely get the whole picture of company's operation. Then it ensures the system is fully recorded. Ensures the system is what's called is fully recorded. It does ensure that the system is fully recorded. We respond with yes. So those are the importance of the flowchart. Importance of a flowchart. We respond to this. Are we together on that? If you're together, we respond to this. So then now we proceed to the limitation or shortcomings. Limitations. So what we call shortcomings of what we call the flowcharts. So what are the shortcomings of the flowchart? So you cannot amend them without drawing. So if it gets to amendment, you cannot basically amend the systems without drawing. We cannot amend them without drawing. We cannot amend them without drawing. So number one, amendments are difficult without drawing. So one is amendment. We say are difficult. We say are difficult. We say without drawing. You cannot amend them without drawing. Amendment is difficult. If you got to amend it, then you have got to draw it together. So my time can be wasted. Are we together? In charting areas that are of no significance. When it comes to drawing, you can say time may be wasted on charting areas which are time can be wasted, on charting areas that I say that are of no significance. You can take time to draw areas that are not of significance. So you can waste much time basically drawing areas that we understand are not of significance altogether. Then we say that flowcharts may contain symbols. In a flowchart, they may contain symbols that may contain what's called symbol that may not be easily we say easily understood. So in a flowchart, you can have symbols that are not easily understood. So you can have symbols that you say that may not be easily understood. That in a flowchart, you can basically have symbols that may not be understood. So symbols can be used, and those symbols, some people may find it difficulties in basically understanding that altogether. Then you can saw, are we together? They show the flow of document altogether. When you look at a flowchart, they basically show what we call the flow of document. Are we together? But however, they do not tell what happens to the asset afterwards altogether. So in a flowchart, they show the flow of document, but they do not show what happens to the assets afterwards. Are we together? Show the flow of documents, show what they call the flow of what they call document. However, does not show, we say what happens to what we call to assets, and you call it afterwards. However, does not show what happens to the assets afterwards. Together, does not show what happens to the assets afterwards. Together, team. We respond to this. We respond to this if we are there. Perfect. So then I want us to talk about features of a good flowchart. Features of what we call of a good flow chart. Features of what we call a good flow chart. Features of what we call a good flow chart, of a good flow chart altogether. So a good flow chart, number one is there should be a header properly. Say it should be. We say properly added. It should properly be added. It should have a proper header. Are we together? Should not be congested with line. Should not be congested. should not basically be congested, should not be congested with lines altogether. It should basically not be congested with lines. Symbol must be clearly explained. If you use symbol, we say symbols must be clearly explained. It should be separate flow chart for each area. There should be separate flow chart, separate flow chart for each area. There should be what you call separate flow chart for each area. So those are the features to characteristics of features to what you call characteristics of features to what you call characteristics of what you call a flow chart. Give me a yes if you're together. Features to what you call characteristics of a flow chart. Give me a yes if you're together. Features to what you call characteristics of a flow chart. Perfect. So I want us to move to what we call evaluating of what we call a system. Evaluating. We call it evaluating the system. Evaluating the system. So in terms of auditors' procedures, we talked about ascertaining the system. So ascertaining, we said understanding what you call understanding the client system altogether. How can I understand the system? By having discussion with the client's management altogether. If there's a manual for the system that is there, I can read that manual to get to understand the system. Then you talked about recording of the system, where we say that you can record using what you call narrative notes. We've talked about descriptive notes, but then we've also talked about what you call a flowchart. So then we get to the next procedure, that is what you call evaluating the system. Are we together? So evaluating the system basically means that the auditor basically tests, are we together? Test or assess the system to determine whether it is effective. The auditor tests or assess the system to determine whether it is effective. Are we together? And why do you test it? To understand the extent at which you can basically rely on the system. So on evaluation, we say assessing or testing the system to understand whether it's effective. We say assessing, or what we call testing of what we call the system, and you say to know whether, the word is whether it is effective, to know whether it is effective. So the aspect of effective is basically to understand the extent of reliance, the keyword extent of what you call reliance. How much can I rely on the system? Then I want to ask a simple question to Sherry. If the systems are very good or strong, can you rely on the system? Can you rely on the system if the systems are strong? If the systems are strong, you can rely on the system. But if you evaluate and notice that the systems are weak, then you should not rely on those systems. You carry what you call a detailed substantive testing. So we talk about techniques of evaluating the systems. We talk about techniques, we call it of what we call of evaluating what we call the system. Techniques, basically evaluating the system. Techniques of basically evaluating the system. So how do we evaluate the system? Number one is ICQ. We call them ICQ. So number one is ICQ. ICQ means that internal control questionnaires. We start with the first one, internal control questionnaires. So one of the first ways to evaluate the system, we have what's called internal control questionnaires. But also we have what we call third-party confirmation. You can also carry out compliance testing. You can also carry out what's called substantive testing. But allow me to start with what you call, you can also evaluate by observing. You can also evaluate through use of what's called ARP. You can also carry out a detailed test That is what we call in-depth test. You can also carry out what we call a walkthrough test. Allow me to start with what we call ICQ, that is internal control questionnaires. Together, team. Internal control questionnaires. Allow me to start at that point. So when you talk about internal control questionnaires, number one, you need to understand that these are a set of questions asked by the plant staff. Are we together? The questions are short and they may require short answers. The questions are short and they may require short answers, such as yes or no. Are we together? So when you look at ICQ, they're broken down to what you call the ICQ, then you have ICEQ. So E on ICEQ, that is evaluation. That is what we call evaluate. So this is internal control questionnaire. This is internal control evaluation questionnaires together. So we can break them to ICQ or ICEQ. Together, Sabrina. Together, Sabrina. If you're together, we respond with a yes. So perfect. So we start with what we call internal control questionnaires. So that is ICQ, internal control questionnaires. So when you say the focus, when you look at those questions, the focus is basically, determining whether control meets specific objective. Focus is to do what? Is to determine whether, we call it control, meets certain objectives. The essence of it is to determine basically whether control basically meets what we call certain objectives. So the essence of it is basically to determine whether control meets certain objectives. Then you have what we call ICEQ. So these are internal control. You say internal control questionnaires. Internal control questionnaires. We have it as internal control questionnaires. Internal control evaluation. There's a word evaluation. Evaluation. And you say questionnaire. Internal control evaluation questionnaires. So when you talk about internal control evaluation questionnaires, we're saying the focus is to determine whether the control can prevent and detect. Focus is to do what? Is to determine whether the control, so the essence of which is basically to determine whether the control, that can prevent, that prevents, control that prevents, and detect what we call specific, a control that basically detect, or we say prevent what we call specific, control that basically detect, and we say prevent specific errors. We have errors, omission, and fraud. Errors, omission, and fraud. And you say that these fraud, errors, and omission that would have no control altogether, that could occur if there was no control. That could occur if there were no control. That is on the ICQ. Understood? ICQ, is it understood? Give me a yes if that is understood. Give me a yes if that is understood. So internal control evaluation questionnaires. So the focus is basically to determine whether the control that detect and prevent what cause specific errors, omission, or fraud that could have occurred if there was no control, that could have occurred, that could have occurred if there were no control. Perfect. That could have occurred if there were no related control. That could have occurred if there was no control. So importance of ICQ. So why do you have internal? They're in these two forms altogether. We say they're basically in these two forms. So what is the importance of ICQ? Importance of what we call the ICQ. What is the importance of ICQ? That are in two forms. What are the importance of ICQ? It enables the auditor to ascertain the system. Enables the auditor to do what? To ascertain what you call the same system. To understand, to have a deeper understanding of the system. We can say enable auditor, identify areas. Auditor, we say identify areas of weakness, areas of what we call weakness. It does assist the auditor to basically identify areas of weakness. Quick and easy to prepare. Why importance? Quick and easy to prepare. Quick, and you say, and easy to do what? To prepare. Quick and easy to prepare as importance, quick and easy to prepare. Then you can also talk about ensure that all controls are considered. Ensures that all controls, we say, are considered. It does ensure that all controls are basically considered. It does ensure that all controls are basically considered. It does ensure that all controls are considered. But you can also say that it provides what we call direct evidence about control. Provide what we call direct evidence, and you say about the control. It provides what we call a direct evidence about the control. So that those are the importance of ICQ. Respond with a yes if you're together. That is ICQ. Give me a yes if you're together. So that is the first method of evaluating the system. So we can talk about third-party confirmation. That is so simple. We say third party as a second, third party confirmation. So in order to ascertain, when you say third-party confirmation, what does it mean? What is third-party confirmation? Third-party confirmation. This is just comparing evidence from third-party sources altogether. Third-party sources with information in the client's record. Third-party sources, we say third-party sources with the information of what we call of the client's record. So who will be the third party? Who will be the third party? Who will be the third party? Third party sources who definitely have who are with the information in the client's record. Example of a third party. Suppliers, yes, definitely. You can confirm. You can basically confirm. You can basically confirm the strength of their control, the strength of their control. Then you can talk about what you call the compliance. Compliance, call it compliance testing. We can talk about what you call the compliance testing. So what is a compliance testing? When you say compliance testing, compliance. For example, if I want to know, for example, if I want to know compliance, for example, when you say compliance testing, for example, if I want to know whether stock movement, whether a company basically does stock movement, I will just check the bin altogether. I will check the bin, whether the records are being inputted. That's a compliance testing. I just pick the bin and I look and compare with the system altogether. I look at the bin and I compare with the system. That is what we call compliance testing. But you can say is a test of control that basically determines extents that you can place on the system, extents that you can place in the system. If you look at those bins and you compare with the system, and there's a difference, what does it say about the system? And you notice that is there controls? Is there controls? If I look at the bin and you compare with what is in the system, and you find that those are different, it means that the controls are not very fair, controls are not very are not strong altogether. If you look at the records and the system as part of compliance testing, you find they're not complying. So that basically tells you the systems are not very effective altogether. And that's why we say that controls, these are tests of control that basically determine what we call the extent of reliance. But I have expanded them further. Together, team. Are we together? We respond with a yes. So we can talk about substantive, or we can talk about substantive testing. So whenever you touch on substantive, you're basically saying that you check the client's account. You're basically checking client's accounts to do what? To confirm what you call number one, accuracy. To confirm accuracy, you check the client's account to confirm what you call accuracy, validity, and what you call completeness. Validity and completeness of what you call of info in what you call in the client accounting system. So you check what you call the accounts of the client to basically confirm validity, accuracy, and completeness of information in the client system. Together in what you call the client system. In the client system, we respond with the yes. We respond with the yes if we are together. If we are together on that, we respond with the yes. So you can look at observation. Observation, what is observation? You go and check altogether. ARP, we talked about racial analysis, cross-sectional analysis. We have the reasonableness check. We had comparing financial and non-financial information. That is what's called the ARP. So I want us to go to actions taken by auditor if the systems are weak. If you perform evaluation and you notice that the system is weak, action, we say action taken by the auditor, if we say the system, if the system is weak. So what are the actions that are taken by the auditor if the system is weak? So you talk about actions taken by the auditor, and you say that if the system is basically weak. Action taken by the auditor. If you evaluate and notice that the system is weak, what are the actions that you're going to take? Bring the weakness to the attention of the management. Through what? Through management letter. Bring the weakness, bring what's called the weakness to what you call to the attention of management. So you say that you bring it to the attention of management using what you call the management letter. Using the management letter. Bring the weakness to the attention of the management using what you call the management letter. Using the management letter. Again, as an auditor, you can do what? Document weakness and provide recommendation. Document weaknesses, and at the same time provide recommendation and provide what you call recommendation. How do they make the system better? And provide what you call the recommendation. Document, put them down, and in a management letter, when you're providing those recommendations, and of course, when you're writing, bring the weakness to the management letter, recommendation to the management letter, and provide what's called recommendation. How better they can make the system effective. You can say the next we can talk about document the weakness in working purpose. Document the weakness. Document what's called the weaknesses in what's called in the working purpose. So document the weaknesses in the working purpose. Document what's called the weaknesses in the working purpose. For reference, we call it for reference. Reference in subsequent years. We call it years of audit. In the subsequent years of audit. For reference, you say in the subsequent years of audit planning. You can also change audit approach. Change audit approach, especially when the approach, for example, you had a mind just to sample maybe a few documents. You have to sample a lot. Which can approach from system-based to voting, from system-based to vouching. So when you talk about vouching, you're trailing the transaction from the origin. You're trailing the transaction from the origin altogether. Again, you will do what? Increase the sample. If your intention was to have a small sample, you'll definitely increase what's called the sample. Increase what you call the sample. Increase the sample. You'll definitely, if you notice the weakness, together, change timing of audit and begin earlier together. Change timing and you begin earlier. Change timing. So now you're going to take a lot of time. Change timing, and you say begin, we say earlier. Change the timing of an audit and begin earlier. Because the work that you have for a system that is weak is basically a lot. Change the timing and begin earlier. Are we together? And begin earlier. So together. So you need to notice that if the weakness persists, are we together? If the weakness persists, bring it to the attention of those charged with governance and the shareholders. If you notice that this weakness basically persists, bring it to the attention of those that are charged with governance and what's called the shareholders. If the weakness persists, bring it to the attention of those that are charged with governance and what's called the shareholders. So these are actions that we basically, as an auditor, you carry out if you notice that the system is weak. Together, if you notice that the system is weak, give me a yes if you're together. If you notice that the system is weak. So I want us to talk about the management letter. Part of the management letter we have discussed on actions taken by the auditor when the systems are weak. So management letter. We talk about management. So what is a management letter? Management letter comes from who? It comes from the auditor to who? To the client. So management letter comes from the auditor to the client, and the essence of it is to highlight weaknesses identified in the system, but at the same time provide what's called recommendation or improvement and any other matter that the auditor may wish to raise to the management. So we say a management letter, number one, is from auditor to who? To the client. It is from the auditor to the client. Are we together? Sherry tuko pamoja. Management letter is definitely from the auditor to the client. To the client. Is from the auditor to the client. I want us to respond with a yes. Is from the auditor to the client. Are we together, Sherry? Sabrina, are we together? Are we together, Sabrina? Is from the auditor to the client. Are we together? Is my network okay? Is my network okay? Perfect. Thank you. So a management letter is from the audit to the client, and the goal to the client, a letter written by the audit to the company, highlighting. The word is highlighting. So the word is highlighting, lighting, what you call the weaknesses. Highlighting what you call the weaknesses. Highlighting what you basically call the weaknesses. Identified by auditor. By the auditor in the system. Weaknesses identified by the auditor in the system. Weaknesses identified by the auditor in the system. And provide, and say, and provide, we write it here. And provide, and say, and provide what's called recommendation. And provide what's called recommendation. And provide what's called recommendation. And provide what's called recommendation for improvement, for what we call for improvement. But you say in any other matter, and any other matter, and you call it in any other matter, we call it in any other matter of concern, that the auditor deemed necessary that the client, that the management should know. Any other matter of concern that the auditor may wish to raise to the management, that the auditor may wish to do what? To raise to the management, may wish to raise to the management. Any matter they wish to raise to the management. That is what's called a management letter. It is from the auditor to the management or the client, highlighting weaknesses in the system of the client, and at the same time providing recommendation. But we've added in any other matter that an auditor basically wish to raise to the management. Are we together? We respond to this. So we proceed to the purposes. Purpose of what we call management letter. From the definition, how many purposes do you have there? Purpose of management letter. Purpose of management letter. So from the definition, how many purposes do we see there? I can see three. I would say number one, highlighting weaknesses, recommendation, and say the purpose bring any other matters that is of importance to the auditor that needs to be raised to management. So report to management, purpose report to what we call to the management. Management would say the deficiencies of what we call of the system. You report to the management the deficiencies of the system. That's the first purpose. Together, Sherry, about the deficiencies of the system, provide advice to management on how to provide what's called advice to management on how to do what? To improve the system, on how to improve the system. Basically, to provide advice to management on how to basically improve the system, provide what's called advice to management, and to say on how to improve the system. Then you can also say, enable the auditor to communicate to management, enables the auditor, say the auditor to do what? To communicate. We say to the management, to communicate to the management. It enables the auditor basically to communicate to management. Matters that have impact, matters that we say that have impact, to communicate to the management on matters that have impact on the future. That's the next purpose. Impact on the future. Matters to enable the auditor to basically communicate to the management on matters that have impact on the future. That's the third. Then you can say that we can say enable the management put matters, enables the management on this management to do what? To put matters right, to put matters, we say right, to put what we call matters right, matters, right, that would otherwise lead to audit, right, that would lead to what? Lead to audit qualification. Issuing what you call a qualification. So put right those issues that will basically make an auditor to issue what you call a qualified report. Together. Put those matters right that will basically make the auditor to issue what? A qualified together. So we can have the last one, the rest you can read in the note. We call a formal document, call it a formal document, a formal document. We call it a formal document. We call it a formal document that have been discussed with the management, that have been discussed. A formal document that have matters. A formal document put matters that put matters. Call it a formal document that put matters that have been discussed, with what's called management, with the management. So these are the purpose of a management letter. File is okay. So number one, report to management deficiencies in the system. Number two, provide recommendation. Number three, we say enable the audit to communicate to management on matters that have impact on the future of the company. It enables the audit to put matters, now the client. It enables the management, now who is the client, to put matters right that will lead to audit qualification, auditor issuing what we call a qualified report. But you say a formal document that puts matters that have been discussed with management. Those are the purpose of management letter. Together. John, I hope that is at home. So then we talk about briefly as we wrap it up to go to the next topic. We put this at home. Content of the management letter. Content of the management letter. So content, we call it the content of what we call of the management letter. So what is the makeup of a management letter? So on the content is the description. When you're writing those letters, there's description of plant ICS. At the content, we say description of what we call of the plant. Call it of the plant ICS as part of the content. So call it description of the plant ICS as the first content of a management letter. List and description of weakness identified. List and what's called description of what we call weaknesses, and say identified. So we call it list and description of the weaknesses that are basically there. Risk arising from each weakness. So we can have the risk arising, say, from each of the weakness, risk arising from each of the weakness. Risks that basically arise from each of the weakness. Then we can talk about unsuitable accounting policies and practice. You can also have unsuitable accounting policies and practice. Unsuitable accounting policies and practice. Then we talk about non-compliance with accounting standards and legislation. Non-compliance with what's called accounting policies, and standards. So this will be highlighted. If there's non-compliance, you realize that it will be highlighted. It will definitely be highlighted. It will definitely be highlighted. We respond with yes. We respond with yes. We respond with yes. So I want us to proceed to audit evaluations and reviews. Do you have that handout? Have I shared that handout on audit evaluations and review? Audit evaluations and review. Do we have that handout? Audit evaluations and review. Let me write it, then I turn back. Audit evaluations, and what's called review. Audit evaluations and review. Do you have that handout? Audit evaluations and review. John, can you confirm that we have that handout? Audit evaluation and review. Can we confirm whether we have it? Audit evaluations and review. John, do you have that handout? So I'm sharing that handout. So we can have our break as a shared. We can have our break, then we share that. Is that okay, John? But I hope you have the video on forensic accounting. Is the video there? It's a small topic. Yes, forensic audit. So that video is so small, we don't even need to. Yes, we can share the questions, but it's so small. So we can have our break, then we come back. So in this topic, this is a very, very good topic. Some of the things basically emanate from this altogether. So just a recap of what you need to get to understand that. Under audit evaluation and review, we have financial statement assertion and audit procedures. So you're going to discuss financial statements, assertions, and what you call financial statements assertions and audit procedures, and what you call the audit procedures. So one of the things that we're going to discuss, financial statement assertion and the audit procedure. That's the first thing. We're going to talk about the subsequent events, subsequent events. We are going to talk about the subsequent events. We are going to touch on the going concern, call it the going concern. We are going to touch on the going concern. We are going to talk about related party management and representation. We are going to talk about analytical review. We are going to talk about company audits. We are going to touch on audit of consolidated financial statement, audit of the consolidated financial statement. We are going to talk about audits of bank and non-bank financial statements. We are insurance company. We are going to touch on audit of cooperative society. Then we're also going to touch on audit of taxation law. And finally, other specialized audit assignment. I want us to start with the first one, that is financial statements assertion. Financial statement, and we call them assertions. So the financial statements assertions. So what are financial statements assertions? What are the financial statements assertion? When you say financial statements assertions. So that is the first thing. So audit of the bank and non-bank related, we are going to discuss under audit evaluation. This is a very crucial topic. John, I've said that this is a very crucial topic. So I want us to be very keen on this topic altogether. So this is a very crucial topic. So then we have what we call financial statement assertions. What are financial statement assertions? So in a layman's language, you say then these are representations of the directors embodied in the financial statement. Representation, I'm breaking down, representation of what I call of the directors, and you say embodied in what's called in the financial statement. Of what we call the directors, and you say embodied in the financial statement. That is what we call financial statement assertion. Are we together? So we call them claims made by management. When you say directors or management, claims made by, in other words, in layman's language, claims made by management, regarding, we can call them claims, just for us, claims made claims or representation, just call them claims to what we call representation representation made by management, made by, we call the management, and we say regarding claims made by management or regarding a number of things. Number one, accuracy. Accuracy. We have accuracy, integrity, and completeness of financial integrity, and what we call completeness of what we call of the financial statements. So have we understood it? When I say representation of directors embodied in the financial statements, then I've gone further to expound it. Claims to what we call representation made by management. Director is part of management regarding what's called accuracy, integrity, and completeness of the financial statement. We can have assertions altogether. For example, assertions regarding the asset altogether. How do you prove existence of an asset? For example, one assertion, let's say, for example, assertions in relation to the fixed asset. How do you prove existence of an asset? How do we prove the existence of an asset? Who can try? How do you prove existence as one of the assertions that are made as per regard to the fixed asset? By physical inspection, you simply do a physical inspection. Are we together? So it is assertions that are representation of directors embodied in the financial statement or claims made by management regarding what's called accuracy, integrity, and completeness of the financial. Are we together? Regarding information that financial statement basically contain. So when you look at assertions that are classified, we need to understand that assertions, we say are classified. We say they're classified into three. So how many assertions are classified into three? 1 is, 2 is, and 3 is what? Assertions are basically classified into 3. Assertions about account balances. So we have assertions, and we call them about accounts balances. Assertions about what we call the accounts balances. Assertions about accounts balances. Then you have what we call assertions about classes of transaction. Assertions, and we call them about the classes of what we call transactions and what we call events. Assertions about the classes of transactions and what we call event. And lastly, assertions about presentation and disclosure. Assertions, we say about, we call it presentation and disclosure. Assertions about what we call the presentation and disclosure. We respond to these. Assertions about presentation and disclosure. Assertions about presentation and disclosure. So I want us to start. This is assertions about account balances, assertions about classes of transactions and events, and then we have assertions about presentations and disclosure. In simple words, when you say assertion, just need to claims management that management makes regarding information, or you can just say claims management make regarding information contained in the financial statement. So when you look at this is when you look at this altogether, when you look at ISA, International Standards of Audit 500. So ISA 500, International Standards of Audit ISA 500. Auditors should use assertion about classes of transactions and events. About this, assertions on the 3. Are we together? ISA 500 basically says that auditors should use assertions about classes of transactions and events. We have account balances and presentation and disclosure. In the sufficient, should use them in the sufficient. In the sufficient, you should use them in the sufficient. You should use them in the sufficient detail. Should use the sufficient details, and you say regarding should use what's called sufficient detail regarding. We say detail for assessment. For assessment, sufficient detail for assessment. We say that sufficient detail for assessment of risk. We say of what we call of misstatement. Risk of misstatement. And the design, and what we call in the design, and you say in the design performance, and the design performance of further audit procedures, Together, that is ISA 5, and it talks about this together. So that the auditor should basically use assertions on the three in sufficient detail for assessment of risk of misstatement and design performance for what's called further audit procedures. That's why you should use the three as a assertion. I want us to start with assertions of account about the account balances. Assertions. We go to the assertions. We call it assertions about what's called the accounts, about the accounts balances. Assertions about the accounts balances. Are we there? On assertions about the accounts balances. Give me a yes if you're there. Assertions about the accounts balances. Give me a yes. So on accounts balances, we have assertions, existence, rights and obligation. We have valuation. We have what's called completeness. We have four. When you talk about accounts balances, assertions that we make there, we have existence, we have rights and obligation, and then we have valuation and completeness. So the first assertion that it makes on the account balances is what we call the existence, is what you basically call existence. We call it existence. We call it the existence. So the first assertion that we make is what you basically call existence. So on existence, you're basically saying that asset and liability are we together? Assets, liability, and equity. Assets, liability, and what we call the equity element. Equity elements, assets, liability, and equity element, and equity elements, including financial, included in what's called the financial, included in the financial statement, actually exist as at the date, exists as at the balance sheet, exist. So we say that elements of assets, liability, equity, elements included, actually exist as balance sheet date. Actually exist as at balance sheet. So that is first and balance sheet. Together, that is existence. Are we together? Together on that, if you're there on that, we respond with a yes. So we have the second, we call it rights and obligation. The second assertion on accounts balance is right and what's called obligation. So whenever we touch on rights and obligation, the entity holds the right and control of assets and liability. The entity, we say that the entity holds holds the right and obligation. We're basically confirming that the entity also called rights and obligation, rights and control, rights of what we call and control, The entity holds what's called right and control. We call it right and control to assets, and what we call and liabilities, to assets and liability. The entity holds the right and control to assets and liability, and liability. Are we together? And liability. So the entity holds what we call rights and obligation of assets and liability. That is on rights and obligation. Together, team. Give me a yes. The second assertion, that was rights and obligation. Existence is that asset and liability equity actually exists as at the balance sheet date. And you say, how do we confirm that? This also we can check by purchase document, rights and obligation. We can look at the purchase document. Then we have what's called valuation. We have what's called valuation. So on valuation, we're basically talking about that. We are saying that we are actually saying that assets liability. Just a minute. So we are saying on this, sorry for that. We're saying that assets, liability, and the equity, assets, liability, and equity, assets, liability, and equity are included in the financial statement, are included in what's called in the financial statement at an appropriate, we call it at an appropriate, are basically included in the financial statement at the appropriate amount, and say and measured, at the appropriate amount and measured, at the appropriate amount and measured as per identified, measured as per financial, we call it reporting framework. That is valuation. That is on the valuation. If you're together with respond with the yes. Then the last one, under accounts balances, we have completeness. Give me a yes if you're there. We have completeness. So on completeness, we say that asset liability, assets, liab, and what we call an equity element, and what we call the equity element, and the equity elements have been included in the financial statement, have been included in what's called in the financial statement. Completeness is that assets and asset liability and equity elements should have been included in the financial statement. That should have been included. Asset liability element. That should have been included. That should have been included. Are included in what we call in the financial statement. So it says that assets, liability, and equity elements that should have been included in the financial statement are actually included in the financial statement. That is the last assertion on completeness. Respond with a yes. On completeness. Respond with a yes if you're together. That is on completeness. So then we go to assertions about classes of transactions and events. Assertions about classes of transaction and events. So we just note classes of transactions. We call it classes of what we call transactions, and what we call events. Assertions on classes of transactions and events. So we have about 5. We have occurrence. When we talk about one of the assertions that we carry out is occurrence. So one of the first assertions is occurrence. So it's a transactional events recognize transactions, and events in what's called recognized in what's called in the financial statement. Transaction and event recognized in the financial statement actually occurred. Actually, we say occurred, and say they actually occurred, and they pertain to the entity, and they pertain. We say they pertain. The word is that they pertain to what it calls to the entity, and they pertain to what it calls to the entity. They actually occurred, and they basically pertain to the entity, and they pertain to the entity. So the next assertion about classes transaction, we call it completeness. So on completeness, we're basically confirming that transaction events should have been recognized are actually included. Should have been recognized are included. So we're basically confirming that transactions and events that should have been recognized are actually included in the financial statement. And we have what's called the accurate. We have what's called accuracy. Together on accuracy. Are we on accuracy? Are we together on accuracy? Perfect. You're not getting me well. I'm saying, John, can you hear me? John? It's your net. Can you hear me, Sabrina? Sabrina, can you hear me? Sherry, can you hear me? Can we confirm if you two can hear me? Kindly confirm if you two can hear me. Sabrina and Sherry, can you hear me? Kindly confirm if you can hear me. John, can you? Can you hear me? We respond to the yes. Can you hear me, Sherry? Sherry and Sabrina. If you can, then you respond to this. Sabrina, can you hear me? Sabrina and Sherry, can you hear me? Can I be heard? Sherry, can you hear me? Can you hear me? You respond to the yes if you can. Can you hear me? John, can you hear me? John, can you hear me? Sabrina, can you hear me? John, can you hear me? Can you hear me? If you can, then you respond to this. John, can you hear me? Let me change that net. Let me change the net. Can you hear me? Give me a yes if you can. Can you hear me? Perfect. Thank you so much. Thank you. I'll change the next. So you're basically on assertions on transactions and events. We say occurrence. That is basically transactions and events recognized in the financial statement actually occurred and they pertain to the entity. On completeness, we are basically saying that transactions, we are basically saying that transactions, when it comes to completeness, we are basically saying that on completeness, that transactions event that should have been recognized in the financial statement are actually included. The transactions and events that should have been included, that should have been recognized in the financial statement, are actually included. Then you have the next assertion, that is on accuracy. So on accuracy, you're basically saying that amount in data relating to the recorded transactions and events have been recorded appropriately. So when we talk about accuracy, we are saying that transactions and events have been recorded appropriately. Are we together? Amounts relating to what we call transactions and events in the financial statements are recorded. We say accuracy, we say recorded appropriately. The word is recorded appropriately. So this one is basically recorded. So we say amounts relating to the transactions and events in the financial statements are basically recorded appropriately. That's what we call accuracy. Then you have the next assertion from this. We call it classification. We call it the classification. So on the classification, you're basically saying that transactions have been recorded in the correct class. Transactions recorded in what we call correct class of what we call class of accounts. That is accounts. That is classification. So this confirms whether transactions are recorded in the correct class of the account. Together, John, they have been correct. They have been recorded in the correct class of account. Then we have the last assertion, that is the cutoff. We call it the cutoff. So on cutoffs, we're basically saying transactions and events have been recorded in the correct accounting pin. So when we talk about cutoff, we say that transactions events have been recognized. We call it recognized in what's called the correct accounting period. So when you look at this, we say that when it gets to cutoff, we're saying that transactions and events are actually being recorded in the correct accounting period together. So we have on presentation, we'll start on presentation, and what's called the disclosure. We'll start on presentation and disclosure. Thank you so much, and God bless you. So we'll start on presentation and disclosure. That is where we start. Presentation and disclosure. Unless somebody has something that is burning, I beg to stop on that. Yeah. Thank you so much to JK. Thank you, JK. So God bless all of you, and God bless our class.